Start. Okay, so Aisha, we are live now. Okay, before we rush into the discussion, first, I really appreciate for your time. It's always great to talk to you, and especially very few people I get to talk in detail, especially about oil and gas, and very few people I get to talk and invite from Middle East. So it's always pleasure to have you.
Thank you for
So,
having me on, Sachin. It's
for,
it's a great pleasure to be
oh,
back.
it's pleasure is mine. So before we start, I think would you like to give just a small intro for of yourself, just for anyone who is listening first time here? Just please go ahead.
Sure. So, as you know, I started my career as a corporate banker with Standard Chartered Bank. I spent about 10 years, over 10 years there, and then I moved to a regional corporate bank. So basically, my corporate banking experience has been studying, analyzing companies, and these are large corporates. So, giving out multi-million dollar loans and basically looking at family groups. And from there, I actually joined a family group after that. And I was their head of treasury. I was managing their asset book, which was at the time about $1 billion. Various assets, so listed equities, real estate, hospitality. So again, it was managing the assets, managing the flows, managing the banking side of things. And from there, I sort of learned a lot, and it was a great experience. But the time came for me to think about doing something for myself, and so I left and I started a consulting, and I consulted with a couple of banks, with a couple of large companies. And finally it felt like working from home would be a really good option, so I joined the partnership with TraderAid with two of our friends on Fintwit. And yeah, so that's what I'm doing right now.
No, I think this is great. So let's jump into the discussion straight away, Aisha. And the first thing that all of us are discussing nowadays is that is it the start of a bull market or is it a bull trap? I mean, for last 5 6 weeks, and everyone is discussing about it. But I mean, to be fair, there is no consensus, and there is no. I mean, a lot of people don't know like what it is at this point. What do you think?
So you're right, it is a little confusing. But then again, when you look back throughout history, there's always been bear market rallies that have, rallied to 10%, even sometimes 20%. So a couple of weeks ago, I think I put out a chart which kind of showed that, even during the worst bear markets, there were bear market rallies that were in excess of 15%, sometimes even reaching all the way to 40%, in fact. And you could say that that would actually be a new bull market, but now we realize that it wasn't. So, bear market rallies are not uncommon. And when they do happen, they obviously are what we call face ripping rallies, right? So, we do see them gain a lot of momentum very quickly. And obviously, they create a situation where it seems to feel like it's a new bull market. But at the same time, we realize only in hindsight that it's not. So I don't think this is really a new bull market. I think we're still very much in a bear market. And the reason is if you take out some of the stocks that are rallying at the moment and you put them aside, you can see that there is still a lot of cracks underneath the surface, right? So we do see that the market is still weak. We see the cost of capital going up. So the macro factors are still there. Not to mention my favorite factor, which I've been talking about for the last 2, 3 months, which is the earnings recession, unfortunately. And I think we're getting a glimpse of that now. So far, we're seeing a negative 5% plus, growth. So it's actually a downtrend in the earnings right now. So, and these kind of situations never lead to a new bull market to begin with, right? So it doesn't, it's not the start of a bull market. So I think we're still very much in a bear market rally.
That makes sense. And in my experience, Aisha, what I've seen is that most aggressive rallies happens during bear markets or during at the peak of like an extreme bubble. So even I'm confused because nothing has changed in terms of macro. I mean, you can expect some rally because of rotations, that some companies are extremely beaten and people want to rotate out of energy and other sectors. So, but I mean, the raise that has seen, it's yeah, it's I don't know how to defend this at this point. So I'm very cautious. Okay, I mean long most of the time, but my covered calls aggressiveness pretty much defined, like I'm bearish or I'm bullish. So my covered calls are pretty much in the money at this point. Okay, so the next part again, I mean this is something again, I'm not an expert, and I follow you and I mean Eminem a lot on this part to understand, okay, what do you think like Fed is doing? My understanding is that Fed will take rates to at least 5.25, even it is for ceremonial purpose. They are not going to stop behind before that, and they will not start cuts immediately, because unless it will look like that that they have overdone it. I mean, the ego is far bigger than they move like an elephant. So, what's your view on Fed? I mean, are we expecting any cuts by the end of this year? What do you think, or is it going to be very tight year in terms of monetary policy?
So, to answer your last question first, I think we're still going to have a very tight monetary policy regime, and I don't think that they will cut rates before the end of the year. Now, I've been wrong on the other side, where I didn't think that the Fed would hike so aggressively, and that took not just me, I think a lot of people by surprise. Their resolve in hiking, the way that, they just went boom, 75 basis points, that was, a whole different Fed. So it wasn't the Fed that we knew, it wasn't the Fed that we were watching for the last 2 years prior to the hiking cycle. So at that point, I sort of thought that they would go maybe 4.5%. And now, in the December meeting, they kind of came up with 5.25%. Now, if you do sort of, the calculation between, inflation, real rates on the curve, and then as well the Fed funds rate, it more or less should stop there. It should stop at 5.25%. But of course, now you still have other people as well coming out. So you have Jamie Dimon, you have Citigroup now following on today, who says that, rate, they won't be surprised if rates go to 6%. However, when they say rates, I don't think they're necessarily talking about, the Fed funds rate. So maybe they're most likely referring to bond rates versus the Fed funds rate, right? So I think even if the Fed funds rate stops at, 5.25, I think we still see a tighter situation in the market. And I think we still see higher rates overall because of the QT, because of the liquidity coming out of the market, right? So I think with the situation that, and it's not a situation that we've really faced before. We haven't seen quantitative tightening, so to speak, and especially not when the balance sheet has been this large. So this is definitely going to push up the cost of capital and push up bond rates. So I think when you say, are they going to cut rates? No. When you say, is it going to be tight? Yes. Do I think they're going to stop at 5.25? Quite possibly. I doubt they will have to go further than that. But you're right. In the last meeting, Chair Powell said that if we need to over tighten, we will over tighten, because for them, they feel like they can fix the over tightening, but pausing prematurely would be worse for the economy.
Makes sense. Hey, Aisha, would like to have your feedback on one thing. Like, so we are seeing now that because rates are high, so the U.S. government has to pay significant money on their debt. Also, I think by the middle of this year or by September, I think the presidential race will start also heating up, especially at this time. And I mean, U.S. is probably as divided as I have ever seen it is.
Mm.
Okay, and it's very difficult. Like, so on one hand, you have Democrats who want to spend like there is no tomorrow. On the other hand, you have Republicans who want to ensure that Democrats should not spend even a single dollar. Okay, so that, and so there is like there is a Fed narrative about rates, But then there's a government narrative about rates where the government wants to would like to stop increasing rates because unless they have to pay more and they cannot print money at this point because of the situations between two parties. So I see this as something as a very strong catalyst that will force Fed in one way or other way to 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 stop increasing rates. And my understanding is that probably it will be done in a way that a particular candidate takes a credit for this. But I don't know. I mean, this is just my hunch. I mean, what do you think is in terms of would you see any pressure from U.S. government directly, indirectly coming to Feds?
Well, the Fed is supposed to be an independent institution, right? And they're not supposed to be political. They're not supposed to be influenced by politics. But, we know what goes on. I mean, life isn't so simple. Now, in terms of whether the government will force them to sort of, stop tightening, I don't know. But, so they've given a target of 5.25 now. Nobody seems to be saying anything much about this. So I suppose if they stop here, things should be okay. But if they probably go higher than that, you might have a situation where you don't have just the government, but you have like several other powerful parties, including Wall Street, putting pressure on the Fed to sort of stop.
No, makes sense. Makes sense. I think that makes a lot of sense. So, but what do you see the rates at the end of this year? I mean, above five, at five, below five.
So I think it stops at around. So if your lower bound stops at around 5%, I think that's where we land, like between 5.5. I think.
Okay. So now we have settled, okay, where we see the rates. If that is the case, then where do you see the bottom of indices if it hasn't bottom yet? I mean, the 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 indexes has been quite a discussion that the way rates have risen and the way the bear market has hit everything. The indexes, in a lot of people's opinion, hasn't declined that much. And the idea was that in 2023 we are going to see significant decline in a lot of earnings, and that will trigger ultimately indexes to bottom. That hasn't happened yet. I mean, actually, indexes actually not only they're actually rallying right now. So, uh,
Yeah.
I mean, if what where do you see? I mean, like, do you see that the I mean, where do you see the bottom? I think let's keep it simple.
So I did some calculations earlier in January, and I'm going to be bold with my call, okay? And it's fine. I might be wrong, but taking into consideration, the cost of capital and the way demand is coming off QT and everything. So translating that into earnings, for example, I kind of landed somewhere between 3,100 and 3,200. So I think that's about where we go. I mean there are some calls for the worst case being 3,000 on the SPX. But I think 3,200 seems like more of a target to me.
Okay,
So
I have not seen a single. Please go ahead, Aisha.
sorry. So basically, we do have quite a lot more to go on the downside. And this is quite a steep target, but I think this could be sort of, you could say it's kind of the worst case situation.
No, I agree. I haven't seen a bear market, and especially this kind of steep bear market where not even a single time the circuit breaker has triggered so far on the indexes. So my view is, I mean, it is a very simple that we have yet to see the bottom indexes. We might have seen bottom in some stocks because they declined too much, and still they will be under pressure. If the indexes breaks, everything breaks. There is no place to hide. And At this point, my view is that I mean, indexes are being held almost artificially at these levels. It's just not sustainable. Okay, companies, lot of companies are doing pretty bad in terms of cost, in terms of productivity. I don't see that that indexes can really hold these levels and can rally from here. I could be wrong, but that's my strong belief. And that leads to my next question: is that why we are seeing such a meme stocks and crypto pumps rallying? I mean, because these were common associated with the height of euphoria, and then we
Yes.
go into one of the bottom, which I wouldn't call it a base, but a bottom during a bear market. There is a bear market rally, but this bear market rally is also coinciding with a lot of meme stocks pumping, a lot of crypto is pumping. And the funny thing, like for example, we saw in last 2 weeks, we saw that AI stock was pumping, and there was only one news that came, and the news they said, oh, they are going to integrate Chat GPT,
Mm.
and suddenly the stock rallied almost like 200% from there. I mean, that's not healthy, and that's not even sustainable, or that's not a that's not common market behavior. It's like so what has happened, like suddenly that these people who were flushed out of market, they still want to come back and do. But I mean, this is small rally of meme stocks and crypto. um, I don't like it because I don't understand, like suddenly out of blue how it started.
Mm. So yes, you're right. I mean, it's a very interesting situation, and I think Mayhem and I have had, several discussions around this because it isn't something that you normally see. So even the previous rallies that we've had during last year's bear market, none of them were led like this. There wasn't so much of a meme stock mania. There wasn't so much call buying. So this time there seems to be two separate phenomena, right? So there seems to be a situation where you have people playing zero dated calls, or zero dated options, and then you have a second situation where you are have a lot of short covering, and that short covering leads to a rally because of the float size. So I think, and taking a step back from that, I think our kind of theory around this is sort of last year was a terrible year for a lot of people, right? I think it caught a lot of people off guard because no one realized how quickly the indexes would fall this way. And for most of the year we were in a bear market. And when you look at people on Wall Street, when you look at the funds, when you look at, most of the world, they're long only, right? So they had no choice, and they probably couldn't hedge as fast as well last year. So they had no choice but to sort of take the hit, let's say, or take the losses. So this year we have a situation where many of these people are quite possibly trying to make up for those losses. Now, you and I both know it will take a lot more than just this much of a rally to make up for the losses of last year. But we do what we can, right? And so I think when you see this level of call option buying, and there have been charts out which say that this is the highest level of call option buying in a very, 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 very long time. You know that this cannot be driven just by retail. It's driven by the institutions. So we have a situation now where the institutions are playing the lottos as well. So the institutions have stepped in and started, to do or to take on zero dated options. And part of the reason that they're doing this is because it's easy, right? So you get in and you get out on the same day. There is no margin you're carrying on your books overnight, and it's a good way to make money. So it's not but having said that, it's not sustainable, right? Because you can keep doing this forever. You can do some of it and recoup some of your losses, but eventually, um, it seems very scary, and it feels like all of this will come tumbling down like a house of cards. So a rally led by meme stocks, a rally led by short covering, a rally led by options. I don't think this could be a rally that we want.
No, I agree. I mean, it doesn't seem healthy. Now, before I move to next question, I actually have a sub questions because you mentioned about it. We are seeing an excessive option buying at this particular point, and a lot of options, and we are seeing like the amount of calls that has been bought is pretty high. I mean, it's
Mm.
I understand in terms like okay, there is a rally. People consider it as a bear market rally or a, I mean, or coming as a bull market. There is going to be call buying, but it's just too much. There's a lot of call buying happening. What do you think? It's more retail or it's more institutions or hedge funds that is driving at this particular point?
Look, the levels don't justify retail call buying. It cannot be because last year retail took a huge hit, and you've seen various, let's say, balance sheet numbers of for retail, or we've seen various, net worth numbers for retail, and we've seen this come down a lot. Okay, so the data says that retail doesn't sort of have the ability to do this to this extent. So it it's definitely got to be, hedge funds and institutional players. But what's interesting is we can't tell really who those institutional players are. So, but it can't be driven just by retail. No way.
That makes sense. But I mean, I'm surprised. And nowadays, like especially for last 3 months, I've actually increased my option exposure a lot because now I have more time, so I can spend time modeling, working some strategies. So my option trading has actually increased quite a lot since last October. So I'm seeing market more and more now. Also, I mean, nowadays I have very less NDAs, so I can trade freely almost in a very long time. So that's
Mm.
one of the reason that activity is picking up from my end. So Aisha, before we move into our favorite sector, oil and gas, I want to ask one question, and you don't have to give me the company's name, but I just want to understand that how's your portfolio look like nowadays in terms of sectors?
So look, I have a long short book, and the way I've positioned is I like consumer staples. I like uh, healthcare. So I am looking at healthcare, particularly in terms of, say, hospital services. I think that, after what they've faced for the last 2 years with COVID and the pandemic and all of that, I think hospital services are picking up a lot. So that's one. Staples, obviously, it's defensive. It will do well in a recessionary or in a slowdown, in an environment that is slowing down. On the short side, I think I mean, I have a few housing related, I have a few tech related, but most of my portfolio is driven more based on the fundamentals. So it's not just looking at, the sector in general, but also looking at strong or weak stocks within a sector. But if you consider sector wise, I would say I am more pro consumer staples, utilities, some industrials, and healthcare. And obviously, the rest of the world is cons. I also do like a little bit of gold. So I'm looking at gold, a little bit of China, and for longs. And oil is a mixed bag.
Okay, makes sense. Hey, Asha, one question and bit personal here, because I got couple of time I got opportunities from Middle East to especially from family offices, and I never worked in family offices. I mean, to be honest, I'm not an even investment professional. I just ended
Mm.
up accidentally in this domain somehow. And so, could you tell me your experience working in family office like? Because I mean, the opportunity that I got was that a particular family wanted me to manage their energy portfolio and high growth tech portfolio, which companies
Mm.
both PE and public equity. I mean, I do work part time in a fund, but that's different from like working in a family office because I have never worked in a family office culture before. So I thought it would be a good idea to understand like what's your experience out there.
So, I mean, I had a really interesting time working for a family office because after spending all those years in banking and, having, you know, policies and reports and all of that, it was very interesting to work, for a family group. And in fact, when I say family, actually, it was more of a one-man show. But I was very fortunate because the owner of the company is probably the smartest guy I've ever met. He was extremely sharp, extremely hands-on, um, which is good and bad because there was a little bit of micromanagement, but at the same time, he was extremely intelligent. He was extremely savvy when it came to investments. So it was easy for me as well to sort of discuss investments, discuss my, strategies, and, we would, weigh pros and cons together. So my situation was a little unique, but I have banked a lot of these companies, right? And the one thing I can tell you is it's an interesting dynamic. It's very different from obviously working in a multinational or working in a bank. You really don't have a lot of policies and procedures. I mean, you do have papers that show you policies and procedures, but there aren't really many that people follow, right? So, but if you work for a good family, or if you work for like a good owner, I think, you can really, really get away with enjoying yourself. You meet a lot of people, and there's a lot of growth there as well because a lot of interesting proposals, cross your path, and it's not just doing one thing. Every day is a different day.
Now makes sense. In this is my personal aim that at some point I want to have my own family office. If you that I mean that's my goal at this particular point. That this is what I'm working. Whatever investing I do is I want to manage it via family office.
Hmm.
And yeah, I mean I'm very open about sharing it, but that's pretty much what I'm looking. So now let's move to our favorite sector, and that is oil and gas and energy. And we had a blast last year. I mean, everybody in the energy sector made a lot of money. Eventually, they made quite a lot of money because industry was very capital efficient coming out of a long down period, and suddenly the
Mm,
oil prices were high in almost like no time. Okay, on top of that, the way the policies were working, it was looking very clear that the supply loom is going to be quite extended. Okay, over the time, the shocks been normalized. When the winter was starting, everybody was worried that how the gas supply in the Europe will look.
mm,
Market is still like having a kind of a supply loom, and as far as pricing is concerned, I think the pricing control only lies at this particular point in the hand of OPEC. Nobody else control the pricing. Okay, US production we saw that has risen over the time, but given the average prices range, the production has not risen as much as it should have been. Of course, I mean there's a lot of policies that should be responsible for that, but that's a discussion for some time. Now the question now comes is, and here is how I see the situation. I see that oil and gas companies have printed a lot of money last year. They have significant uncertainty when it comes to invest money for longer term projects. So they are paying a lot of dividends. They are also investing a lot in the renewables and low carbon because that's what the pressure is. But they'll be doing a lot of M&A this year, in my opinion, because the uncertainty on the long term are going to see a lot of uptick in the M&A activities. We are sheet with high debt for oil and gas companies who are in distressed assets. They want to offload some of these companies either via IPO or by selling it. But overall, I still see that oil and gas will have this year pretty good. I mean, if it's not as good as last year, but still it's going to be pretty good. Yeah, that's my view. What do you think? It's a boom, it's bust, it's average, it's good. How do you see the oil and gas this year, and How do you see the geopolitics this year moving forward as well?
Are you still there? I think I've lost you a little bit, Sachin. Sorry, you went offline for a second there.
Sorry, I think there is some issue at my end.
Mm.
Can you hear me now, Aisha?
I can hear you. I can hear you.
Okay, perfect. So, Aisha, how do you see the oil and gas, story this year, and how do you see like the geopolitics around it during this year?
So I think you're absolutely right where the M&A is concerned. This is something that, I was listening to some of the calls as well for, the US companies, and this seems to be, a good policy that they can employ to sort of grow their base, right? But taking a step back, if you look at OPEC, I think OPEC is more or less looking at a situation where they want to remain stable for now. So after their, historic cut sort of thing that they did last year, I don't think that they will be making a lot of changes until at least the end of the year. So things are more or less stable right now. I think where Brent prices are concerned, uh, Brent staying over 75, $80 a barrel is actually what they need. And as long as it's, remains at that level, I don't think that they will be looking really for price cuts. Now, in terms of the geopolitical situation, I think Russia, for example, it still remains a wild card. um, Exports haven't stopped. We might see some decrease in exports this year, but I don't think it will be a lot. The price cap has been increased now. So it's just a matter of how to get these exports around and the delays, right? So on the supply side, I don't see a huge, let's say, downturn in supply. But at the same time, I think on the demand side, with the world slowing down, most people are looking at a situation where we might have, a recessionary environment, and therefore we might have, lower demand for oil. But I think a lot of this hasn't taken into account the fact that China is reopening now, and not just reopening, but they're looking to really boost their consumption. So while I think they have stockpiled quite a bit, and that might carry them over through the first quarter, maybe second quarter even, I think the back half of this year we see higher oil prices once again. So where we are in the interim is probably somewhere between 70 and $80 a barrel for WTI, a little higher maybe for Brent, or around the same range, and possibly a little, maybe another maybe $5 to $9 higher per barrel towards the second half of the year.
That makes sense. See, in Middle East, do you see activity around like, like making the oil and gas zero carbon? Like, for example, they are selling oil, but you can also consume some sort of offset pricing. Okay, like for example, so if Saudi is producing oil and let's say they are producing the cheapest in the world, so Saudi has a scope. Ki, okay, why don't we take a charge of $5 to $6? We put it either for CCUS or some other way to offset it. But there's a discussion around it. How do you see? Like, you see that there's a discussion around you with not the oil net zero, but the shipment net zero by offsetting. Do you see there is uptake in Middle East around that?
So there's definitely an uptick in, green energy and talking about green energy, clean energy. So in the UAE, for example, we have the government-led initiative of Masdar, which is the clean city, and it's going to be all renewables. And so there is a huge, huge push for renewables here. So don't get me wrong, they have that part of it, but it's not directly related to the oil. So I kind of see both the initiatives going in parallel, but not sort of overlapping. Does that make sense?
Hey, Aisha, can you hear me?
I can hear you, Sajin. Can you hear me?
Yeah, I can hear you. I think there is some issue. So sometimes the signal is weak at my end. I don't know what's the issue. I really sincerely apologize for that. So I think
No
before we
problem.
lose the signal completely, I think let's go to the most interesting question.
Mm.
Okay, and that is on the Indian market, and we were discussing
Mm.
offline as well and the impact of Adani. So tell me, who should go first? You would like to go first, or shall I go first? Yasha, can you hear me? Asha, I think you go first because I mean, at least the signal from your side looks pretty good. So at least you hit the mark. I mean, the answer first on this one. So let me take this question in the meantime. I mean, what's the outlook for stock market? I mean, we were covering this in the first section. I think the crude summary that we covered was based on okay, that we still see this rally as a bear market rally, and we do expect that the it's very difficult for indexes to actually rally and continuously, and we do expect some sort of downsize moving forward in terms of indexes. The interest rates are still rising, but let's see how it moves forward. Okay, Aisha, you want to take a take on the question?
What's the outlook for the stock market?
Yeah.
So I still think that, we have, so with every bear market rally that we've had last year, the stock market is sort of, gone down one more leg. And I think we're going to have a situation where we're still going to go down one more leg. And I say this mainly from the perspective of earnings, because as far as I am concerned, I don't think that we've seen the bottom of the earnings cycle as yet. And I do believe that we are yet to fully experience, the earnings recession. So we've already started experiencing some of it last quarter. And don't get me wrong, I'm not talking only just about the big tech earnings. And also remember, just beating estimates doesn't mean that earnings are actually okay, because a lot of the times what's happening is you are seeing a quarterly decline in earnings, but because estimates have been taken down so much, the companies end up beating, right? So what we really need to look at is the quarterly growth in earnings, and that will give you the real story. So I do think that, for so we're closing out Q4 now for earnings, and I also think, say, Q1 is not going to be all that great. I think we're going to go further down. My feeling would be that, we see somewhere around, let's say, August, September, where things start to stabilize again, you know. Until then, I think we continue to see bear market rallies, and we continue to see the market go down with every bear market, or at the end of every bear market rally. So my idea would be maybe early summer or during the summer would be a great time to start looking at, stocks to buy, because I think that's sort of the time when we see prices come down massively. So I've already started like looking at, because if you really want to look at companies, I think it takes a little bit of time. You can't look at them overnight. And I think a lot of these companies are seeing a great reset, right? So everything that they've experienced in the last 2 years, it was fueled by liquidity. In fact, in the last 5, 6 years has been fueled by excess liquidity, right? And so I feel like a lot of these companies are going to be resetting. So it's a great time for us to look at which companies will actually survive and which companies will actually do really, really great from here in the next bull market, right? So I see this year as a great year to actually learn and to be able to pick some really good companies, make longer term investments, make medium term investments, and even like swing investments.
I think that's an excellent summary, Aisha. So, Aisha, let's get back to the Indian market and Adani's impact. Let me give you my summary first on this one.
Yes.
See, I think the timing for the Hindenburg report was actually a bit tricky for me because see, if I'm going to short a stock, I would like to increase the float as much as possible. So I should have waited for the FPO. Okay. So as a pure tactical point of view, I could have waited for FPO before releasing the report. That could have exposed Adani significantly. Okay. Adani's status in India, I think it has increased quite a lot. There is no second thought about it. On one hand, when I see like the company, and I have to be very brutal on this part. I mean, I see that there is a company which is run as a family, and the corporate governance has been an issue. It's running more like a small hustlers at time, but the way they are expanding, the way they are delivering infrastructure projects, and now they are having the cheapest solar. Output based on that. I think the main challenge was the company that facing was that I think the promoters had a large percentage of the share.
Oh.
Okay, so the one of the challenge that I saw with the companies, and I have seen it with several countries as well, that conglomerates, the way they go, they try to find the loopholes and they try to work around it, push things, and that's pretty much what they have done. They use their position at times that to ensure that they have required capital, which is in this particular case in the form of a significant debt, which has been justified at times using the high infrastructure projects. Okay, but the company's corporate governance, I think the questions on that, I think they are valid. As far as going back to say that is it a fraud, I think I'll not go that far. My idea is that it's a company that has been that's a public company but run by strictly by a family.
Mm.
Okay, there are issues on corporate governance at times. There are issues in terms of how leverage it is. There are issues at times in terms of like how they are using the loopholes in different parts of the financial market. I think everybody has done that. I think in US there was a time when Rockefellers and JP Morgans have every economy when they grow there are always conglomerates like that and every country has it.
Mm.
So Adanis are no different. So I don't see them as fraud. Be focused and they are now responsible to deliver more than ever.
Mm.
I do see one of the big challenges that I don't see like when I see the research of Hindenburg and previous reports they have done that all of it is done entirely by themselves. I mean, Adani has been a target of several, uh, several people. So somebody coming along and supporting Hindenburg with information and
Yeah.
direction, it's very likely. And the reason for that is because the report just came before the FPO. If you are going purely from short point of view, you would like the FPO to happen before you publish the report. So that's pretty much my idea is like okay because there was a clear intent that okay somebody wanted to stop that
Sabotage. Yeah.
but there is a lot of work Adanis have to do, and there is an impact on Indian market. But overall, the euphoria and the momentum the Indian market is having, I think they'll see it through fast. I think the banking is the most exposed sector here,
Mm.
but given the elections next year, I don't think government will try a lot of shaky grounds and things will be tightened soon. That's my opinion. Back to you.
No, it's very interesting because I read some of the report, not all of it. It's a very long report. But I spent my life banking companies like Adani, right? So the large conglomerates who are still like family owned or majority family owned. And the interesting thing is, uh, I think you put it very well. So that I wouldn't go so far as to call them frauds either. And I would think it's more about cutting corners and it's the cost of doing business, that kind of a thing. And in countries like India, in countries like Bangladesh, Pakistan, I think when you have infrastructure projects, there's a lot that goes on there to get these projects, right? And so I don't see them doing anything that's abnormal. I think it's quite they are debt ridden, heavily debt ridden, and that again is a factor of being in the infrastructure sector. But what's more interesting, I think, is the kind of attention that they've drawn to the Indian stock market and the attention that they've drawn to India and the markets in general on that side of the world. And I think that's something that, I sort of wanted to hear from you as to how you felt about something like that.
Makes sense. So, I have one question. So, like, when you see outside, I mean, so I'm biased because I come from India. You are seeing it, somebody who is sitting in Asia but seeing it from outside. I mean, how do you see it will impact uh, in short term, long term? I mean, do you think that it's a temporary stubble? I mean, or it will improve soon, or how do you see it?
So look, I think with every big, um, you know, issue like this, I would say that people tend to lose faith, right? So that's, I think, the biggest issue that they cause people to lose faith in the stock market. They cause people to lose faith in the economy or in the way the stock markets are run, let's say. So I think there were a lot of allegations that, the government is turning a blind eye, or, the markets are not efficient, or the regulators are not looking into things. So I think that's where the biggest issue lies in something like this, that you sort of give the markets a bad name. And in developing countries, it's already difficult to, let's say, attract investments from outside, right? Foreign investments and, the likes. And when you see something like this happening, it's sort of, you lose faith not just in the stock markets, but in the financial markets and a little bit, the economy as well. So I think from my perspective, that would probably be like the ugliest fallout from something like this.
That makes sense. I think that's very helpful. So, so I think before I completely lose the connection, I don't know what's wrong with my internet today here. Any final thoughts from your side on markets and commodities? What you'll be more keen in terms of key numbers moving forward, especially this month and next month? I mean, this is going to be there are many earnings that are positioned in this time. But what are the two or three companies you're most excited in terms of earning results and all that? Let me know.
So I think interestingly, like the big tech is already gone, right? And we've seen most of the bigger companies already put out their earnings, which was quite interesting because we didn't see the kind of reaction that we thought we would see, with earnings coming in worse than expected, especially for the likes of Apple or for the likes of, Google, Amazon, even Microsoft. So I think we continue to look at where this all takes us, right? So at the end of the day, I think we have the big picture and the big ideas, but let's not forget that, we are here to make money. So at the end of the day, I'm still very much focused on what I can buy or what I can sell or what I can avoid on a weekly, on a bi-weekly, on a monthly basis. And yes, that is driven a lot by the fundamentals. Yes, it's driven by the macro. But at the same time, I think if we keep our eyes open, we'll have some great opportunities to, for swings. We'll have great opportunities for longer term investments in the next 2, 3 months.
No, it makes sense. In my case, I mean, like, I'm more excited about um, some of the earnings. Really, big tech has been my focus. I mean, I wanna see like how the oil and gas companies report because I'm expecting that they'll be carrying a lot of cash that could trigger, like I said, the M&A for this year. And banks is also something which is on my radar, that how they come up with, did they really manage to take advantage of the high interest rate environments or not. Of course, I mean, the high tech is my favorite sector all the time. The one thing which I'm looking is also some of the not the earnings but the financial statement that comes out of private companies, especially in the fintech sector. There has been some recent improvement. I want to see like how these companies hold, because
Mm.
fintech sector is really beaten, but I believe that there are several good companies are lying there. So there could be some bargains, and if things are in right direction, probably we'll be able to make some money on that. I think that's my final thoughts.
Good. I mean, I think
So
fintech is
he,
also a very interesting place. Yes.
no, makes sense. Hey Asha, I mean, I don't know. I mean, really sincere apologies. I think something messed up at my internet today. It's been breaking, but really appreciate for your time and help. I hope I should not see these issues again when we meet again next time. Really appreciate for your time. It's always great to talk to you and learn from you. Okay, thank
Thank
you.
you, Sachin. Thank you for having me on. And let's do this again soon.
No, sure. I mean, I'll sort it out later, like what the issue was, so that I don't see this issue next time we connect.
Okay. Take care.
Okay,
Thank
thanks,
you.
Aisha.